The successful loan officers offer value add for realtors on here's how to create more business. And I think that's the exact way to do it. And it's proven. Everybody knows that. That's a great way for loan officers to partner up with realtors. I think with reverse mortgages, the approach needs to be a little bit more, hey, I know you're hearing mixed things about this. Come learn about what it is. Like it's a safe place to come and learn objectively how these things work. It's not a sales pitch, because people are so used to getting sales pitches, and real estate agents, loan officers, financial advisors, estate planning attorneys, accountants, they're hearing both sides of this already, because the thought leadership, the people that really understand finance, are telling the professionals in their space, this is something that isn't what it seems. You need to know about how this works. And so they're the people, including real estate agents, that are hearing both sides of it. They hear what everybody else hears, which is like, oh, reverse mortgages are terrible. But they're also hearing people that they know are smart thought leaders saying, it's not what you think, and it's a clever solution in a lot of cases. So I think the marketing around reverse mortgages needs to be about, here's what they are, here's what they aren't, here's where you can use them, here's where you don't want to use them, so that they feel safe, like they're coming to quiet these voices so that they can figure out how to use them. And I don't think we do that very well in the industry. But I think this product is different in that way, that they want to feel comfortable knowing that they can talk about it coherently before they're comfortable talking to their clients about it.
Yeah, it is something realtors tend to be more open to learning about, rather than lenders want to talk about other programs and they're like, oh, it's another sales pitch. I think that's kind of what you're saying, is like they're actually open to hearing about this strategy from an objective learning perspective.
Where is still controversial, so they want to hear, well, what is the truth?
Where did the bad connotation come from, though, with reverse mortgages? Was this, and let me preface that too, was there a bad connotation before the 2008 crash as well? Has this always been a thing, or what are your thoughts on that?
This is the Loans Elevated Podcast, your weekly dose of market insights, financing strategies, and all things real estate. Presented by the Lassig team, a top 1% nationally ranked mortgage team.
But I also think there's a thing going on, and we touched on this yesterday in the CE class. There's a thing going on that I think it strikes our intuitions like cold water. Until you actually study the financial aspect of what's going on, our intuitions kind of recoil from the fact that with a reverse mortgage, you are allowed to let the charges on the loan accrue on the balance rather than paying them, which is why mortgage payments aren't required on a reverse mortgage. You can make whatever payment you want, just like any other mortgage, right? If I have an interest-only mortgage, I can always pay more than interest. Right. If I have a 30-year mortgage, I can always pay more than what they're requiring. But they're just, like, when we talk about a 30-year mortgage and what the payment is, what we're really saying is that's the minimum payment. You can pay anything above and beyond that. And the same is true with a reverse mortgage, only the minimum payment is zero. And if you don't pay what the interest is on the balance, then they just accrue it on the balance. And so because you can do that, I think a lot of people think that that's what you must do. Like if I get a mortgage and I don't make a payment, the balance that I owe is going to grow. And that is true financially, but what that means is if the payment on that amount of a loan, let's say it's $200,000, the payment on that would be around $1,500 or so on a normal 30-year mortgage. I'm estimating, but it's close enough. Well, I can pay the $1,500 on the balance on a reverse mortgage, and the balance will go down and disappear over 30 years. But I have the option to not make a payment, and the balance will grow. And sometimes people look at that and they'll say, oh my gosh, the balance is growing. That sounds horrible. And it's like, well, hold on a second. You're also saving $1,500 a month. What did you do with that? And if you threw that money down the toilet, then it would have been wasted. But don't do that with $1,500 every month, by the way, anybody. Right? But if you're investing that and that's earning interest somewhere, then that's offsetting in a positive way the balance sheet. So yes, you might have this liability accruing, but you also have this asset that's growing that's offsetting that. Now, most people don't do that, but that's something that could be done on a balance sheet, and it's very simple to understand that, oh, that's okay. If I borrow $200,000 and I let it accrue, but I invest that money somewhere else, those things are my balance sheet is the same thing either way.
Well, go ahead. Continue.
Well, I'll finish with this. Yeah. What typically happens, though, is people don't make a payment, and they forget, and they're not investing the $1,500 a month. They're buying food or medicine, or they're visiting their kids and grandkids, and they forget that also has economic value that expands over time, which is normal. That's how money works. But it's hard to quantify. It's hard to account for that because it bleeds into our lifestyles, and you don't have some number that you can look at that says, oh, I spent $38,000 this year on groceries and visiting my kids and going to do things that I like, and on a gym membership that was tough for me to afford earlier, or whatever. Like, lifestyle has an economic value, and we're just using it in that way. And guess what? There's absolutely nothing wrong with that. If my parents said, hey, we really need to stop making a mortgage payment because we're having to skimp on our food and our medicine, how do you think I would reply to that as a loving son or daughter, anybody? It's going to be like, yeah, mom and dad, don't you dare sacrifice a single iota of lifestyle for the sake of my inheritance. That's ridiculous. Now, whatever's left when you pass away, awesome, thank you, that's a blessing, but I don't feel entitled or that I deserve an inheritance at your expense.
Or that you even want it. Like you don't even desire any sort of limitation on their life while in their remaining years to hopefully get a few more bucks in inheritance.
That's exactly true for me, and I think it's true of
most people.
Everybody I've met. I'm sure there are occasional, I mean, there's people out there, I guess, that you'd want to punch in the neck because they're horrible people and they would rather have money than parents. But for the most part, that's how most people feel. It's them spending a portion, a type of wealth, their home equity, that they've spent a lifetime building. It's them spending it. If that money were sitting in a retirement account somewhere, nobody would ever dare say to their parents, hey, don't spend that. I want to inherit that instead. That's silly. But we say that about equity all the time, but it's essentially the same thing. If you were to say, people say all the time about home equity, well, yeah, but if you spend that through a reverse mortgage, then you won't have it later. And it's like, well, that's true, but that's also true about every dollar in the world. If you spend it now, you won't have it later. But why did we save it in the first place?
It's true about the Social Security income the parents are receiving as well. Like, do you complain that they spend that on a monthly basis? No, right? It's like,
unless you're that fraction of a percent of those kids that are.
We'll just ignore that edge
a-holes.
case. Some crazy person. You know what's crazy? Like you asked that question. Where did the I think you called it the ugly duckling issue come from with reverse mortgages? And I think the issue really is, like, you're taking a very pragmatic approach, but that pragmatic approach is because you have a pretty significant understanding of finance and you don't have emotion attached to debt. The challenge is most of the nation, except for the people in the finance world that understand and study this stuff and know how to capitalize on it, debt and more complicated views on using money. A reverse mortgage is an example of that. You're like, dude, it's the same thing. Look at the balance sheet. It's like more equity, more cash, like we went through this yesterday. People get freaked out and emotional based on a lack of understanding. There's a lack of confidence to understand it. So the emotions come out and say, whoa, this is a bad deal. Not that they don't want their parents or their loved one to enjoy retirement at a higher level, which is really what it does, but it's an immediate negative reaction because of a intimidation factor, I think.
Yeah, I agree with that.
Yeah.
And there's a few things you could say about that. It's sort of like, I mean, we mentioned this yesterday as well, but if you have, so let's imagine mom and dad need a car. And let's say that I'm just going to pick a simple number, $50,000, right? There's cars that are more or less, but let's just pick 50 grand because it's a round number. And they want to, let's say they, in order to buy that car, they sell $50,000 worth of stock portfolio that they've got. Well, if that stock portfolio would have doubled in the next 10 years, then that's $100,000 less that they will have on their balance sheet 10 years from now. Now, there's nothing wrong with that. And if they need a car and that's the car they like and they can afford it, have at it, right? I want my parents to have the best lifestyle that they can afford responsibly. But if you were to keep that $50,000 in your investments and borrow the $50,000 instead from some kind of line of credit, whether it's a margin account on the stock portfolio, whether it's a reverse mortgage or a loan against a life insurance policy, just some kind of debt instrument, if you were to borrow that $50,000 to pay for the car, or finance it for all I care, if you were to borrow the $50,000 to pay for the car, and you never made a payment on that $50,000, you just let it accrue, and 10 years later you owed $100,000, people look at that, and probably rightfully so. Our instincts look at that and they feel like, oh, that was a terrible financial decision. But remember, you have $100,000 in your assets that are only there because you didn't use them to buy the car instead. In other words, your balance sheet doesn't care where you get the money from. And so what wealthy people and high-level accountants and financial advisors that help businesses and wealthy families figured out a long time ago, it's not about minimizing interest that you pay. It's about minimizing all of the costs that you might pay and shuffling them around so that you minimize all of it. And what I mean by that is, if I take the money out of my investments, I pay an opportunity cost to do that. That's the $100,000 of investments that I don't have 10 years from now. That's an opportunity cost. And people that track finances, they know how to track that, but it isn't tracked automatically on your statements. In other words, my stock portfolio that I get doesn't show me every quarter what the things that I sold would have been worth had I not sold them. Statements don't work that way. So opportunity costs are easy for people to pay because you don't have to look at it. Whereas if I borrowed the money, I have to see that accruing, or I have to make the payments, one or the other, and I see that happening. It's just more salient. But wealthy people and families figured out a long time ago, like hundreds of years, by the way, this is not a new idea, which is one of the reasons why wealthy people simply get wealthier, is that they understand that, well, I'm not trying to minimize interest costs. I'm trying to minimize all costs. So if I can figure out a way to pay interest instead of opportunity, because the opportunity cost would be higher and I want to leave my investments where they are, then I'll pay interest instead of opportunity cost because it's smaller. And if it can also help me reduce taxes, like I'm trying to minimize all the things that I don't want to pay, not just interest. So that old phrase.
There's not an emotional connection to any one thing, is what you're saying. They don't have this. This
well,
tunnel
or maybe
vision
that's
of
just
one
shifted to my emotional connection is I want the best outcome at the end.
Exactly. Yeah.
And they've just learned to overlook the things that cause emotional reactions that aren't mathematically real.
Right. Yeah. Yeah.
Well, to that juncture too, you're optimizing leverage. Your asset is still appreciating in the home.
Yeah.
Like it's not happening with.
Well, the crazy thing is you mentioned arbitrage yesterday, and it's like that's a real thing as it relates to these reverse mortgages. If you keep the money in your portfolio rather than spending the cash, in general, that's like probably 2% higher than what the rate is going to cost you on a reverse mortgage. Your ROI on the portfolio is probably around 2% or maybe better than that. So that arbitrage, you're actually, it's not going to work out. You conservatively said it's going to work out equal. If you took 50 grand from cash or you borrowed 50 grand from some sort of debt, in this case, the reverse mortgage line of credit, it's going to be equal. But that's not the case because it's going to, the interest, at least right now, and the whole time I've been in the business over 17 years, interest rates have always been lower than what the return on investment could be with cash invested in some pretty reasonable portfolio, nothing crazy risky.
Yeah, I mean, it kind of depends on where you're putting the money, and people are free to do that. It gets pretty sticky from a compliance perspective to encourage people to use the money for that reason.
Right.
But I intend to do that. And if you think about it indirectly, if I use the cash, if I borrow the money in this line of credit rather than selling investments in my portfolio, I'm not like taking the money out of my home to go invest it,
right.
But indirectly,
exactly.
I'm kind of hoping for some arbitrage because I just want to leave my investments alone.
Yep.
And if those investments are in an IRA or if they're in a brokerage account and they've appreciated in value, I'm saving a lot of taxes by just not distributing the money. So it's not a taxable event when I take the money out of the house. And you know, one of the things we do a lot in this industry is we talk about what you can do on the fringes, and I think we neglect to tell people or to explain to people what a reverse mortgage is at its core. I think if you asked 100 people on the street to describe a reverse mortgage accurately, maybe one could do it. But if you were to ask those same 100 people, how do you feel about reverse mortgages? You'd have 80 of them saying, "Oh, they're bad,"
right?
And they can't describe it. So, like, ask yourself if you're hearing this or watching this, ask yourself how you feel about reverse mortgages, and then ask yourself, can you actually describe what one is? And if you can't reconcile those two things, rethink it, because if you can't describe it, what's the point in having an opinion about it? And frankly, what will happen is once you learn about how it works, what you think I'm going to say now is probably, if you're watching this, you think I'm going to say, "Oh, once you learn how it works, you're going to love it." But you're not. Once you learn how it works, you're going to realize that that's a ridiculous question, how you feel about it. Because it's like me asking you, so how do you feel about hammers?
Right.
It's like, well, I like having access to a hammer because sometimes I need one, but it's not like I love hammers.
Right.
I love having that tool when I need what a hammer can do.
Yeah. That's a perfect segue. So for the people that are just viewing this that don't even know what a reverse mortgage is, how would you explain that to the Joe Schmo on the street that's just trying to learn?
So the way I like to describe it is by comparing it to other options that people have. So let's say I come to you and I want to borrow 300 grand. And I'm oversimplifying lending. I know that it doesn't really work this way, but let's say I want to borrow 300 grand and you say, okay, that we charge 7% for money, right? Again, I'm oversimplifying to a large degree. And I say, okay, well, what are my repayment options? And you say, well, we can amortize that over 15 years, and the payment on that would be about $2,700 a month for the next 180 months. We can amortize it for 30 years, and the price for that, or the repayment for that, would be, about $2,000 a month, 360 times, and then the loan will be satisfied, and everybody, we're done. And then you say, well, I've got an interest-only option, and that'll be $1,750 a month. But those are minimum payments. As we mentioned earlier, when we talk about payments on a mortgage, We're talking about minimum payments. You can always pay more. So from a financial perspective, if I'm good at budgeting and I'm good at allocating my resources, there is absolutely no way I would ever pick any of those three options other than the interest-only option, because it gives me the most control over my cash flow, because it means that I can pay $1,750 or more. And if I pay the $2,700 a month for the next 180 months, the loan will be gone. It will be satisfied, just like the 15-year mortgage. But the 15-year mortgage is a requirement to pay the $2,700. And if I could only pay $1,750 as a minimum, then I can make that loan whatever I want. I can amortize that over any period that I want. And I know that I can always fall back on the $1,750 if I need to, because I'm short on cash, or if I want to because I have some other opportunity with my cash that month that I like better than paying down a balance on a mortgage. So sometimes people will respond to that by saying, yeah, but if you choose that, you'll never pay down the mortgage. And me being a responsible adult, usually, and us dealing with other responsible adults, I'd say, well, yeah, but that's a choice that they can make.
Right.
So I want the option to pay whatever I want, whenever I want, and if that $1,750 is my minimum, I want the lowest minimum. Investors do this all the time, by the way. Investors love interest-only loans because it gives them the most flexibility.
Yep.
So we outlined those three loans. There's the 15-year, the 30-year, the interest-only, and the interest-only is the one that gives you the most flexibility over your cash flow. Well, there's one other option. I call it option 4, but it's really what a reverse mortgage is, where the minimum payment is 0. And what that means is I can let the interest accrue on the balance, or I can pay the interest. I could even pay some of the interest and only let it accrue a little bit. I can pay the interest and principal. I can pay whatever I want, whenever I want, and I don't have to decide at closing. I have that flexibility each and every day. I can let the charges accrue, or I can pay them, or I pay them more, pay down the balance. I could pay them with some investments. And it's structured, most reverse mortgages are structured as a line of credit, so I could even take more out. And my required payment on the money that I take is 0, but I can pay anything I want. For the life of me, I don't understand why the industry doesn't talk about it in that way. They always talk about, oh, it's cool, you can live in the house without making payments, which is true. But I think until people understand the fundamentals of how that works, then that just sounds too good to be true, which I think is where the myth comes from, where people think that when you get a reverse mortgage, the bank owns your home. That's not true. That's never been true. But it just sounds too good to be true for me to be able to borrow money and not have a payment. People think, well, if that happens, the bank must own my home. They don't. You just have a balance on a mortgage that you can let accrue or pay whenever you want.
And I think that's where the issue comes in. I mean, that is phenomenal, by the way. The way that you explain it, it's just like you're simplifying more complicated finance that most people don't understand in such a great way. And I think it's a powerful tool. I told you yesterday that I helped my grandma get one of these years ago. Like
my parents have one too.
Yeah, it's amazing. Like 8 years ago, but she had a lot of these same concerns. Now, the reality is most people that are interested in one of these, well, I guess it's twofold, but most people that are interested in one of these desire no payment. I know she did, my grandma, and the clients I speak to, one of the main benefits is they can live in their home and they don't have a payment obligation. The other benefit that my grandma really enjoyed was access to the equity through the line of credit facet. But it took she trusted me with everything. And even with the implicit trust to do anything with her finances for all of my adult life, basically, she trusted me with this stuff. It took me months to help her understand, like, this is not, you're not going to lose your house. She was so sweet to want to leave an inheritance for her kids, my aunts and uncles and my mother. And it took me forever to explain to her, because she wanted this missed payment, but to explain to her that you're not going to lose the house like you're saying. And you're actually still most likely going to be able to leave an inheritance just based on historical trends in real estate. She ended up leaving several $100,000 after having the loan for 8 years, something like that, and still left an equal amount of inheritance that she would have left had she just stayed in the complicated home that she sold with stairs that was not comfortable for her as an aging person. She left the same amount despite the fact she didn't make payments for 8 years, and it dramatically supplemented her lifestyle. With the line of credit, she could pay for a car, so on and so forth. So maybe let's shed some more light on that piece, because you were talking more of like the optionality of this as a finance option, meaning you have 0 payments and you could do whatever you want. I think that's or a 0 obligated payment, but you could pay more if you wanted and the balance wouldn't accrue. But the reality is, even if you stick with the option where you don't ever make a payment, based on just the way it's underwritten and the way the banks manage the loan-to-value ratios and the way real estate appreciates over time and always has, historically, obviously no future guarantees, you're still going to be put in a position where you have significant equity, probably equal equity, by the time this person passes away.
Yeah, and I'll just double click on what you said about optionality, because if you get a mortgage and it's really important for you to leave a legacy to the next generation or the next one, then make payments.
Right.
Right.
Yeah.
And so I think about, if I were in that situation or position, let's say with my wife, who will probably outlive me statistically. We're about the same age, but women outlive men typically. And it's very common for the age gap between a couple to be a few years anyways between women and men. So not only do they live longer age-wise, they're often married to older men. Now, that's not true. We're just talking about statistics, so it's not true in every case. But I imagine, so when my wife and I, by the way, if the reverse mortgage, the FHA insured reverse mortgage exists the way it does today, when I turn 62, I'll be signing on my birthday because it's a line of credit that I want access to. I don't know if I'll need it. I don't know if she'll need it after I'm gone, which is where I'm going with this. But imagine, imagine I want to leave an inheritance to my kids, but I get cancer, and it's a long battle with cancer, and it eats up more of our resources than we planned for when we planned for our retirement. And I predecease my wife, and she outlives me by 15 years. Well, what if my desire to leave our children an inheritance is something that we have to negotiate in the future, or we have to balance between buying food for ourselves sometime in the future, or medicine, or care, or whatever. Like, I don't want her to have to make that choice because we locked ourselves into a mortgage payment that we could afford at the time, but something changed. Mm-hmm. So I love the optionality of the whole thing, because if you're 65 years old, what are the chances that you know how much money you're going to need for the next, let's say, 30 years?
Right.
The answer is zero. You don't
Right.
know that. Now, we talk about financial plans, but I think the word preparedness is probably a more important word, because you don't know what's coming down the pike. You need to be flexible and nimble and be able to handle different things. And so having an option, if I feel like I can afford to, without skipping meals, or without my wife skipping meals after I've gone, if we can afford to make our mortgage payment down, or pay the mortgage down so that the kids get more equity when we pass away, then make a payment. Mm-hmm. And if that ever changes, stop making payments or take some of the money back out. I want the flexibility, because I know what I want now for my children, but I don't know if I'll be able to deliver that. I could get diagnosed with something tomorrow.
Right.
I want flexibility.
Yep. Access, certainty on having these options for the unexpected, really.
Yeah, and another thing that people forget to balance out on top of that is, let's say I really want my kids to inherit a lot of equity, and so I just keep making a mortgage payment. Well, if I'm taking cash out of my retirement funds, or out of my Social Security check or my pension just to make payments on the mortgage, the same thing would happen for your children if you let that mortgage accrue instead and put the money elsewhere. They're going to inherit all of it, right? They're either going to inherit more equity or more investment accounts. The money goes somewhere. And if you can't afford to put it in one of those two places, it's because you need it to eat, or to visit the kids and grandkids, or to balance the lifestyle, because we could all give our children more inheritance if we ate beans and rice for the rest of our lives.
Right.
And is anybody telling their parents, hey, will you please just buy hot dogs and peanut butter, because we need to maximize this inheritance? That isn't really how people think. So when you just think about the whole thing as a closed system, that is the value of your wealth, and it's the value of your wealth while you're living, and it's the size of the inheritance when you pass away, it really doesn't matter how much of that is equity and how much of that is investment accounts. So having the flexibility to choose each and every day where I want that money to be, that's what I want. I want to be nimble. I want to be flexible. I want to be prepared, because whatever I plan, now plans are helpful, but I know that whatever I plan isn't going to be the reality, because I'm expecting, say, 8% on my equity investments, my stock investments. Well, we know that's not going to happen. It might average out it might average out to something like that, but it might not. Mm-hmm. But it certainly won't be that each and every year. It just doesn't work that way. But we plan on that, knowing that it's not going to be correct. So the real value is being prepared, not having a plan that is so accurate that you know that what the future will be, because that's ridiculous. We don't know.
I love that.
And it is so funny. People tend to, from a mortgage perspective, it's all I've done. And I know you were in the finance world, not mortgage world, for much of your career. But it's so weird, because people look at mortgages in a silo and fail to recognize. I mean, that's the whole That's the whole mission of our mortgage business. We call it holistic mortgage planning because we try to encourage people to look at it exactly the way you're describing it. But even as it relates to a regular forward mortgage where you have to make payments like the 15 or 30-year fix, like you're saying, people will look at that and obsess over the payment, obsess over the rate, obsess over the mortgage insurance, and forget like, well, you could just take this cash and pay off that credit card that's 27%. But for some reason, it feels so different for people. And the same thing's being said here. For some reason, spending the Social Security check or the IRA or whatever feels so different from people. So I think the idea here, if we could just like give one poignant idea, is just zoom out and look at everything as a holistic ecosystem of finance, right? In your family's portfolio, not the mortgage and the house. And I want to leave the equity.
I couldn't agree more. And so the book that Dan and I wrote about it, I don't mean this to be a plug, but what I'm saying is the book is called Reverse Mortgages, The Financial Ugly Duckling. And we have a chapter in that book that is titled The Most Important Thing. And that's what it is. It's like, you can't just look at this in isolation. You have to, it's sort of like, I don't know, there's this law in thermodynamics that you can't create or destroy energy. It's preserved or transferred in some way or another. Sometimes it's bled out through heat. Sometimes it transfers to another form or mass or whatever. I'm probably getting that wrong, but it's something like that. You can't destroy it. It always goes somewhere. It never disappears. And money is kind of like that too. It transforms from one form of wealth to another, or it gets taken out and consumed in the form of a hamburger for lunch or something like that. But we need that, right? It's transformed and used all the time. It never disappears. Mm-hmm. And so you have to look at all these things and how they interact with one another and how they play on one another. And I've said for the longest time, I remember when I read about reverse mortgages for the first time, my reaction was, this is probably the most misunderstood financial tool and underappreciated financial tool that I've ever seen. And I got kind of passionate about it at the time. And I still believe that's true. And that was the major reason for that, is like, wow, if people really realize how flexible this was and how it could help them optimize the whole picture, it wouldn't have the reputation that it has. But we don't treat it like a financial planning tool, which it should be. And then it kind of dawned on me, well, we should be treating all mortgages like financial planning tools. If my client, when I was a financial advisor, I've sold my practice, but when I was a financial advisor, if my client had a 6 or 7 figure financial instrument, that was a meaningful thing in the overall context of the plan. And yet people have that with their mortgages and their real estate all the time, and it's sort of like, okay, we'll put that on the balance sheet, but there's no point in optimizing that. Yeah, make sure you have a good rate and that's it. But it's way more impactful than that. There are way more options that you can do when you integrate that into the planning process.
And the rate's only a component of it. The mortgage insurance is the payment, so on and so forth. It's all only a component of the overall thing. It's like that's crazy.
Which goes back to what we were saying about the smart people with money. They don't try to minimize interest payments.
Right.
They try to minimize all expenses.
It's a global view. How do I make this wealth get bigger? And who cares what I pay or what? Like, none of it matters. Not one thing matters. Yeah. Just besides, how does this number get bigger?
Yeah. Or how do I use this the most effectively? And the same is true. I mean, we can go into home ownership. This isn't specifically about reverse mortgages, but that's a contentious issue online too. I have adult children, and the reason I say that is because I try to view the world often, because I'm a parent, through their eyes and try to help them, provide whatever kind of wisdom I think they might listen to. Maybe they don't listen. But home ownership is another thing. I tell them, like, hey, there's nothing unethical about renting. Like, you need shelter, because if you don't have it, you'll die, right? It's that important. But I try to impart on them, hey, as soon as you think you're going to stick around in an area for a while, you need to make home ownership a priority. And the thing that people say online all the time, which is it sounds very compelling, but it's completely incorrect, is that, well, yeah, but what if I rent and I invest the difference? And it's like, okay, well, if you do that, first of all, you have to assume, you have to remember, it's not about, well, let me rephrase that. I apologize. They'll say, but if I invest that money elsewhere where I'm getting maybe 8 to 10% in the markets or more, or whatever, like whatever number they say, that, and real estate only appreciates at 3 to 5% on average or something like that, then it sounds like I'll make more money in the market. And the answer is, well, kind of. But remember, shelter is something that, like what you said is true, but it's leading you to the wrong conclusion, which is that you can invest the money that you would otherwise be spending on shelter in the market. That's not reasonable, because you have to have shelter. You have to either rent or buy a house. The way I like to say it is, you're either paying a landlord or a lender. And if you look at the total expense over time, if you add up how much you'll spend to provide shelter, and I'm talking about similar places. So if you're talking about a studio apartment versus a 5,000 square foot home, that's not apples to apples. But if you're talking about renting something similar and buying something similar, the amount that you will spend in rent over the next 30, 35, whatever the rest of your lifespan is, the difference on how much actual cash you will outlay is like a 7-figure number. You will spend $1 million+ less on shelter by ownership. It's a little more now, but of course the cost of rent just keeps creeping up, whereas the cost of home ownership, only part of it creeps up, right? Your tax, your insurance, maintenance, that does go up. But the bulk of what it costs to own a home is the mortgage payment for the next 30 years or so, and that's a flat number. So all of rent is exposed to inflation, whereas only part of home ownership is exposed to inflation. And so by the end, you've spent millions of dollars more to rent than to own, and you own nothing for it.
Yeah.
So I spend less to own a home, which is also great for my family and my kids and having a community and places, somewhere that they can call home. I spend a lot less, and I own something when I'm done that's worth a couple $1 million, because houses will be worth a couple $1 million 30 years from now. It's just, I know that sounds hard to believe, but they were also you could buy a house in this area my first house was in Kaysville. I used to live in this neighborhood, or in this, on the Wasatch Front.
Yep.
And I remember actually, that was my first. My first was in Ogden, and I bought it for $94,000, and it felt expensive at the time.
Yeah.
Like, it just happens. As weird as it would have been for me to hear that houses would be worth $500,000 today, back then I would have said, no way. But they're going to be worth $2 million someday, and that will be normal. It's just hard to believe, but it's going to happen. I don't know if it'll be 20 or 30 or 25 or 35, but that's just the way it works. And you have to learn to trust that, because our instincts fight that.
Yeah. We've even used this just for borrowers to live life a little bit more lavishly. We recently helped a borrower get a reverse on their primary, and then they use that cash to go purchase a second or a vacation home down in St. George. And now they're using that with their grandkids. They're going down and playing golf every weekend with them. Like, it's just, they're living life in a different way that they otherwise would not have been living life.
Yeah.
And now they have 2 houses with no freaking payment,
yeah,
which is wild.
And that's just an opportunity cost that you can't equate for.
Yeah.
I love that idea, because it's sort of like, people think if I take out, this is kind of beautiful, because they'll think, like, people's initial reaction to debt is usually negative, and they'll say, well, if I take a reverse mortgage out, that's some debt. It's like, yeah, but what you're doing in that scenario is you're taking equity out of your house and buying equity in another house.
It's arbitrage.
You're converting equity from one place to another. So you might even say, I don't think this is the main reason to do it, but from an investment perspective, you're also diversifying into 2 markets instead of 1. So that gives you a little bit of a defensive moat around your wealth. But also, look what you've done. You've just bought a house, a second home that was 100% financed. You didn't have to come up with any money for it. And are they renting it out when they're not there?
They aren't, no.
Okay, some do, some don't.
But you easily could in that type of market. I mean, like,
Yeah, and you could even have that professionally managed, so you don't have to worry about putting it on Airbnb and worrying about the cleaners and things like that. You could have that professionally managed and cash flow and get the equity in both houses. You still own both houses. You could even use the cash flow for the St. George property to pay down the reverse mortgage that you used to get the property in the first place. Either way, like, remember, it's a closed system, so it's about optimizing the tools within it, because it's all going somewhere. And so at the end of the day, you're either using that wealth to enjoy life or not, and it's in that case, it's not even costing you money. You'll die wealthier that way. And even if you don't, so let's say the markets both crash, or something goes wrong, and something apocalyptic happens. Even if you don't, imagine having a conversation with your parents, and they said, you know what, we really want to do this. Because remember, you guys seem younger than me, but I still think of myself as a young guy compared to my parents. I mean, we're all young compared to our parents, I guess. But can you imagine your parents saying, hey, what they're really facing is how they want to spend the last 20, 25, 30 years of their life. It's hard to really sympathize with that until you go through it, and you never get to go through it until you go through it. So, but for these people, that's a big deal. For people that are getting, retirement is that thing. And when you die, it's all over. And so we're thinking, how are we going to spend the last, let's call it 25 years of our life? And can you imagine, going to parents and saying, look, I really don't want you to enjoy that, because you might have to use debt. That same instrument. Yeah, we recoil from debt, but we also forget that debt is what gave us the home equity in the first place. I mean, it was a big contributor, right? Yep. How many of us who have home equity today would have had that if we weren't able to use debt to get that ball rolling? Like, it's a powerful instrument that just needs to be understood, not avoided, because if you avoid it, then you'll rent the rest of your life.
Yep.
Yeah.
That's not a good thing. So you just have to know how to respect it and how it works and how to use it, and use it productively. Like if you're paying 29% interest on a credit card debt, that's bad debt.
Yeah.
Right.
But if you're using home equity to go buy more home equity, or to live a lifestyle that you saved and built for retirement, then I can't
that's
see anything wrong
savvy
with that.
financial management, really. Is that's all that is. It's so funny because we're uncovering this weird, like as you're talking, I'm like, this is wild. Clients will very quickly take a highly dystopian view on, oh, this is debt. Oh, I'm not going to leave an inheritance. Oh, I'm not going to do this. And they will fail to take a utopian emotional view. So I'm talking about emotions here. They will look at dystopian emotions and completely ignore utopian emotions, which is the lifestyle benefits and all these other things that you can, visiting the kids more often or eating a better meal or enjoying life more. Like, it's so wild how bifurcated that is when it comes to discussing mortgages, whether it's a reverse mortgage or not. Like, that is just nuts.
Yeah.
Can't believe it.
I mean, a lot of it, at the end of the day, right, money is I've heard it called a useful fiction, right? Money isn't real. It's something that we created to help account who owes whom what, how do we store value, how do you set some value aside that you can spend later. Like, money's a construct. Everybody knows that. It isn't real. Even when it was backed by gold also doesn't have intrinsic value.
Right.
Its scarcity is what made it useful as a type of currency. But in and of itself, it's not like we can eat gold or wrap ourselves in gold on a cold day.
We just have a social agreement that it's worth something.
Exactly.
Yeah.
And so we treat it like it's this absolute thing, like it's a thing that you can hold and touch, but it's just a representation of value. And when you think about home equity, you can't sell. If you wanted to think about let's say you have $500,000 in home equity, you can't sell a slice of that to spend it. But if that money were in an IRA, you wouldn't think twice about that. And it's not just to cover necessities. A lot of people live on more than necessities, and thank goodness that they do. I don't want my parents eating hot dogs and peanut butter the rest of their life so that I can get a bigger inheritance. So they spend more of their IRAs than are absolutely necessary to live a life that is more than just the bare minimum of sustenance. But when we think about our home equity, I think one of the reasons that we don't imagine using any of that for anything other than a last resort or like an emergency is because you can't sell it piece by piece. I can't put $10,000 in my bank by selling $10,000 worth of my house.
Right.
You can't do it that way. And so the way people have figured out how you can spend assets that you have without selling them in cases where it's not liquid like a home, you can't say that it's not exactly liquid. It's just less liquid. Because you can sell your house, but you can't sell some of it. You got to sell all of it or none of it. Mm-hmm. So, but if you use a line of credit attached to the house, now I can sell piecemeal. I can put $10,000 of my equity in my bank, and people will say, "Well, yeah, but then you'll owe interest on it." And it's like, well, of course, because I still own the asset. I'm borrowing against it instead of selling it, so I have this asset that I don't have to. If you really could sell a portion of your equity, let's say I could sell $10,000 worth of my equity. Now, you might say that my equity, my home isn't going to appreciate by, let's say, 6%, whatever the loan rate is. And that might be true. Home equity, I mean, it could do that, but that would be an aggressive assumption. Mm-hmm. But remember, if I sold a portion of my equity to some investor, if I was buying some $10,000 worth of somebody's equity, I would charge them a proportional amount of rent.
Right.
And you don't have to. So if you think about the fact that the house provides you shelter on an ongoing basis, that's why people pay rent, is because there's value in that. And so the fact that my house might only be appreciating, let's say I projected at 4% or 3% or 5%, there's also, if you want to get technical about it, there's a cap rate on the house that I live in. And I don't actually pay that because I don't actually receive it. But if you think about it, when you own a home, you are your own landlord. Mm-hmm. But you don't pay yourself rent, because why do that? Just leave the money where it is. It's already where it's going to go. Mm-hmm. But if you think about it, every house, every piece of real estate has a cap rate attached to it. But when you live in your own home, that shows up in the form of you not having to pay rent because you would be paying it to yourself, but it is there. So if you were to sell a portion of your house, whoever bought that would be expecting a proportional amount
some sort of return, right?
Yeah. So the fact that I can sell a little bit of my equity piecemeal by attaching a line of credit to it, and again, I can pay the interest on a monthly basis or let it accrue. I can completely choose that if I'm using a reverse mortgage. But even if it's a HELOC, I could pay the interest. It doesn't matter. That's a fair thing to do because I've remained retained control of the asset. Investors do that all the time with margin accounts. They don't want to sell the stock. Maybe there's a big gain. They don't want to pay capital gains on it, so they borrow against it and keep the stock and let it keep appreciating, pay a little interest, but they end up paying less. They end up paying less overall costs because they minimized opportunity cost and paid a little interest instead, and they got wealthier for it.
Yep.
So that phrase that people say about, well, people who don't understand interest pay interest to those who do. People love that because it sounds pithy and it fits on a bumper sticker, so it must be true.
Right.
But it's not true. Wealthy people pay interest all the time. Elon Musk borrowed $25.5 billion against Tesla stock because he probably saved about $8 billion in taxes by not selling his Tesla stock. And his Tesla stock is still appreciating, and he kept control of his Tesla stock. I mean, wealthy people use debt all the time. They just know how to use it.
And
That's
frankly, I think wealthy people would choose to use debt over cash 100% of the time. Like, I can't imagine a time when you would be like, I mean, unless the debt was outrageously expensive or something, which it generally isn't. Like, I would almost always, if I think about my life, if I could maintain my cash and keep it invested or not, I'm always going to choose the maintain my cash and keep it invested. I've got optionality, and it's just like, yeah, it's wild. This is so good. So I want to pivot a little bit. I don't know if you have anything else to say, but you started briefly, and then you're like, man, this is going to be kind of a rabbit hole that we're going to go down. You started talking about some more of like the sophisticated ideas and, I guess, tax alpha strategies with a reverse mortgage in retirement age. Could we dive into something like that to kind of give some clarity on like how you could
I'd
get
love
strategic?
to dive into that.
Yeah, let's talk about it. Me too. So let's hear it.
So let's start with some of the simpler ones.
Okay.
One of the ways that financial advisors and accountants are starting to use these tools, and by the way, it's mushrooming. So there's a book by a guy by the name of Dr. Wade Pfau. It's about reverse mortgages, and that book, he's the head of research at the American College of Financial Services. He's not a financial advisor. He doesn't sell mortgages. He doesn't sell products. He just does research. That book is gorgeous about how this stuff works. And so financial advisors and accountants are starting to understand that this is a very useful tool. And before I dive into this strategy, I'll point out the idea that, going back to this debt idea, I like to remind people that Microsoft, I just use them as an example because everybody knows who they are. They're worth $3.1 trillion, right? This massive company. Do you think they have lines of credit set up with financial institutions all over the world? And the answer is there's no way that they don't. Of course they do. And it isn't because they've run out of money. It's because lines of credit are extremely useful financial tools for people who understand them. Mm-hmm. And so with that in mind, one of the first most obvious reasons that lines of credit are very useful. So imagine I'm going to simplify financial planning a little bit, but with a financial plan, if I'm going to retire, I want some assets that I have set aside to afford my income for the rest of my life. And then if I have enough and if I'm smart, then I've got a bucket of rainy day money that is for contingencies, right? I'm not just planning, I'm also preparing for things that I don't know will happen. So let's pick $100,000 for that number for the liquid, conservatively invested money that I just want access to because I don't know what tomorrow will bring. So let's pick $100,000. That might be a lot for some or not very much for others, but I'm just going to use that because it's a number to do math on pretty simply. So if I have $100,000 sitting in an account that I know is not earning what it could earn if I invested it in ownership of businesses, which is what stocks are, of course, and it's not invested aggressively because what I prioritize with that money is access and predictability. So I have that $100,000 set aside for a rainy day. Now that is costing me, let's say I'm earning 4% on that rather than 10% on average by having my money invested in the market. So if I'm earning 4 and giving up 10, it's costing me $6,000 a year, 6%, and that's a compounding number, by the way. So $6,000 just in the first year, right, and it's more than that every year after. So if I'm giving up 6% growth, that account is costing me $6,000 a year. Now, people often will say, well, yeah, but it's not really costing me. But I'm reminding people, opportunity cost is a real cost. Just because you don't see it doesn't mean it's not happening. So that position or that strategy is costing me $6,000 a year, and many people will understand that. They'll agree with what I'm saying, and they'll say, I understand that, but I still need the liquidity, and I still need the predictability of access to that money, and I agree with that. Well, another strategy might be, well, set up a line of credit that cannot be frozen, that is guaranteed by the federal government, which is what a reverse mortgage is, by the way. They're structured as a line of credit. You don't have to put money on it, by the way.
Which question for you? Is there even another version of that? Even like the portfolio line of credit, accounts. I don't think those can be frozen.
Yes.
Like, I don't think there's another version of a reverse mortgage line of credit that is contractually unable to be frozen.
The only thing that I would compare like that, if you want to get real technical, is like if I have a life insurance policy with some cash value in it, that is mine. I own that, and if it's a whole life policy, it can't go down. If it's a VUL, it could. I'm not saying that those can be good or bad depending on how you use them, but that's something where they can't freeze that because I have the collateral right there and it's guaranteed. But other than that, you're right. If it's just a line of credit set up like a HELOC or a margin account on my stock portfolio, that can be altered and changed outside of my desires.
Right. Or even not a margin account, just a line of credit against the value.
Well, that's what a margin.
Okay, got it.
That's what a margin is set up to be as. Okay. It's attached to a stock portfolio where I can access money at the cost of interest because I don't want to pay the opportunity cost and I want to leave my. So it's a similar thing. Now, if you set up a line of credit as your access to cash, and if it's the kind of line of credit that can't be frozen, like a reverse mortgage, or a life policy technically, because the loan policies are lines of credit on those. That keeps me from having to pay that $6,000 a year cost. So I can have that $100,000 invested back into where it can optimally earn more money for me, and I have access to the cash that I don't have to pay interest on if I don't take the money. Like it's just a line of credit.
Yep.
If I get into a situation where I need $50,000, and it might be an emergency, like a medical emergency. It might be that I want to help a kid go into college or a grandkid, or it could be just something fun. I need a car, or it could be a trip I want to take. Doesn't matter. If I want $50,000 sometime in the future after I set up my financial plan and things are running well, now I've got this line of credit, and I could use that if the portfolio that I would have taken it out of otherwise is in a position where I don't want to touch it. And there could be lots of reasons for that. Maybe the market itself is down and I don't want to sell those at a loss, or my positions in that account are really, really good and I've got a lot of capital gains tax to pay, or I just like the portfolio where it is and I don't want to sell it, or I just want to delay the decision and I say, well, I'm going to take the line of credit now because I need the cash now, and I'll decide tomorrow whether I want to sell. Like, it gives you so much flexibility without having to pay that cost of $6,000 per year on it. I mean, in this example, $6,000 a year of opportunity cost, because it's just a line of credit. It gives me access without having to take a bunch of money out of investments that are invested profitably to put them in something that's going to forego the earnings that I could get otherwise. So that's not necessarily a clever tax strategy. It's just really understanding that opportunity costs are real, and avoiding those where possible is a good idea.
Yeah.
So that's a basic one, that just use a line of credit as your rainy day fund rather than taking a bunch of money and investing it in suboptimal things.
Yeah, so we just shifted, instead of cash is king, liquidity is king. That's the real message.
Yeah, and if I have access to cash that somebody else will give me, then I don't have to pay the opportunity cost of having a bunch of money in cash or short-term bonds.
Well, on a more complicated basis, like my personal situation is, if you leverage lines of credit and use them for some sort of business purpose, like I do a hard money loan, it does become a tax advantage, and my cash is invested and I don't have to use it. Like it's I mean, you can just keep going and going and going with it, but
that's the perfect testimonial of lines of credit are very, very useful tools. Mm-hmm. You just have to get over this initial gag reflex of interest. Everybody's so afraid of interest because they've always heard you don't want to pay any more interest than you have to, and that's not quite correct. You just
don't want to be debt-free, all these weird things.
What really is true is, if you wanted to encapsulate that, is, well, you just don't want to pay expenses that you don't otherwise have to. Mm-hmm. But you're going to have expenses, right? Because I have to eat and I have to, drive a car and things like that. There's going to be expenses, but if I can minimize those and not pay extra expenses, and if I can pay a smaller amount of interest than the opportunity cost, that's good for me. And a line of credit gives me that flexibility. But what I love about it is, well, flexibility. Mm-hmm. So there's also a scenario where I could imagine that $50,000 expense that I might want to make in retirement, and we just talked about, well, you can use the line of credit. Well, it might be in a position where, oh, you know what, my investments have done really well, and I think they've kind of maxed out, and I think I was going to sell some of those assets anyways. I'll just use those. It's always an option.
Right.
So nobody's saying that you have to use a line of credit. It's just something you want in your back pocket.
Yep.
You want it.
And you were going to say something in the class yesterday about that, and you were saying if you had a taxable event, you could take that taxable event and pay down your reverse mortgage and create a 1098 tax deduction that essentially offsets that taxable event. You were going down some path that way.
Well, we have to set this one up carefully because you have to qualify how this can be used.
Okay.
So If you were to ask an accountant, is interest on my mortgage deductible? The answer, like most answers in that domain, is, well, that depends.
Yeah, maybe.
What did you use the mortgage for? So if I own a home free and clear, just to clear this up for anybody that's listening and wants to get technical about it, if I own a home free and clear and I do this massive cash out refi and I use that money to sail around the world for the next 2 years because I have a terminal illness and I want to just see the world, whatever, interest on that mortgage is not deductible. The IRS doesn't allow that. The IRS says it has to be acquisition indebtedness. Now, it doesn't mean you have to use that loan to buy the house. It just means that it has to be attributable to the purchase or improvement of the home. So what I mean by that is, if I bought the house with a mortgage, then interest on that is deductible. But if I refinance that mortgage with another mortgage in the future because rates are lower or something like that, that's still attributable to the debt because I can trace it back, or still attributable to the purchase, because I can trace it back to the purchase of the home.
Okay,
that's
right.
what makes a mortgage. That's what makes mortgage interest deductible. And there's a $750,000 indebtedness limit that creates deductible interest. So there are some limits, but the limits are big. So it's not infinite, but it's not small either. So that's why people generally think mortgage interest is deductible. So what I'll say about this is that reverse mortgage interest is as deductible as interest on any other mortgage. So if the mortgage would have been deductible for the purposes that you use it for a traditional mortgage, then it's also deductible for a reverse mortgage. So if you just think for a minute on how this works, I'm going to use a simple case. Let's say I buy a house with a reverse mortgage. So we know the interest will be deductible as long as it's under that $750,000 limit. Now, whether I use it to buy the house or refinance the debt that was used to purchase the house, that's okay too, but let's just use an example where it's clean and simple. So I buy the house with a reverse mortgage as the mortgage that I bring to the table when I close. So I bring some money down, the reverse mortgage brings in the difference, and then I can pay whatever I want. If you pay nothing for the next, let's call it 10 years or 11 years or so, just to make it simple. Let's say I use a $300,000 reverse mortgage to buy a home, and I never make a payment. And with all that cash flow that I don't have to make the payment on, maybe I'm saving it, maybe I'm using it to eat, or maybe I'm using it to visit family, or maybe I'm investing it, doesn't matter. If I don't make a payment on that $300,000 reverse mortgage, let's say it grows over the next 11 years or something to $600,000. Now again, I know that shocks people, but just remember, I borrowed $300,000 and I haven't made a $2,200 a month payment for 120 months. That's money that I've been shoveling somewhere else, or maybe I've been using it to eat or whatever. There's economic value in not having to make a payment. And it compounding sometimes surprises people. So, but get used to that. That's the way money works. That's the way all the dollars work, by the way. So that's not a surprise. It just can sometimes surprise us what those values become. But here's the key. Now, reverse mortgage interest, if you just let it accrue, you don't get to deduct it for it accruing. But it does get deductible when you pay it, assuming that it's deductible when you pay it. Like, I don't know what the laws will be 11 or 12 years from now.
Right.
But right now, if you have a reverse mortgage that is accrued, let's say you had the original reverse mortgage at $300,000 and it's grown because you didn't make a payment to $600,000, you can make a massive payment on your mortgage that will pay the interest down. Now remember, when you do that, you're converting liquid money into home equity, right? Because you're paying the balance down, so that you haven't changed your balance sheet this way.
Right.
You've taken investments, paid down a liability, and because it's a line of credit, if I pay down my balance, I have access to the money again if I need it.
You just paid yourself.
Yeah, so I could use my line of credit again to pay for my living expenses, which is what I would have used that investment for anyways. Like, it's all fungible, and it's all a part of one closed system. Mm-hmm. So if I take an investment somewhere, let's call it an IRA. This is where this is interesting, and a lot of people have 401k.
Because you have required distributions from this, right?
I'm sorry?
Because of the required distributions in an IRA,
yeah,
is why this is so applicable to an IRA?
Yes. So you could do it with or without the required distributions,
Okay.
But required distributions they're a pain in the butt.
Yeah.
All of my clients now, if you need the money to live on, then you're satisfying the required distributions anyways. But if you don't, it's an administrative pain in the butt. And if you don't do it, the tax consequence is pretty substantial. And it's kind of annoying. Mm-hmm. And you have to take the money out of a tax-advantaged account and put it somewhere else or whatever. But you could so in this example, we talked about a $300,000 reverse mortgage that is accumulated to $600,000. I'm oversimplifying a couple of administrative steps here, but I'm not dodging anything. It's just that some of that accumulation is attributable to a type of mortgage insurance, and how that's deductible has some phase-out limits. Right. So I'm ignoring some of the minutia here, but that's a very small percentage of what we're talking about. But the overall effect here is I take $300,000 out of my IRA, I pay interest on my reverse mortgage, and by the way, you don't have to tell the servicer that that's where you want it to go. It naturally gets attributed to fees and mortgage insurance and interest before principal anyways. So if I take $300,000 out of my IRA, pay down my reverse mortgage that has $300,000 of growth in it, A, I've just opened up more credit that I could take out and live on if I wanted to, but B, I'm going to get a 1098 the following year that shows that I paid about $300,000 in interest on my primary residence that I used to purchase the home. Right, I use that mortgage to purchase the home, so that is deductible. So
Crazy.
if you condense that down to what just happened in simple terms, I took $300,000 out of my IRA completely tax-free. If you're liquid enough to do that with cash, so let's say instead of taking $300,000 out of my IRA and paying down the reverse mortgage, let's say I have $300,000 of other investments or cash in the bank,
the
or
money
something.
market or
If
whatever,
I'm liquid enough to do that with other money besides my IRA, I could pay $300,000 down on my reverse mortgage, get the 1098 with non-IRA money, and I would still get a $300,000 1098. And a lot of people in retirement don't have taxable income of $300,000, so that deduction would just be wasted because it doesn't carry forward like a business loss.
Right.
So that if I have a $300,000 1098, but my taxable income is only $50,000 or $100,000, then I've just wasted a bunch of deductible interest.
Does it carry over?
It doesn't.
Oh, it does.
A business loss carries over, but an
1098
interest
doesn't.
deduction does not.
Interesting. Okay.
So you either use
gotta
it in
be
that year
cautious.
or you lose it.
Okay.
But if I pay, but you would never do this by accident, right?
Right,
We're talking
right,
about
of
moving
course.
six figures around.
Yep.
If I could take out of my brokerage account $300,000 and pay down $300,000 of my reverse mortgage, and all of that is attributable to mortgage insurance and interest, maybe a little bit of fees of origination at the beginning if you rolled that into the loan. But either way, we're talking about most of it will be interest.
Yep.
The vast majority of it will be interest. What I could do with my IRA at that time is convert $300,000 from an IRA to a Roth IRA. Now that creates a 1099. Converting IRA money to Roth IRA is a very valuable thing to do, but you have to pay taxes to do that. You get a 1099 that shows, well, it's a 1099. You get a 1099 for converting IRA to Roth IRA.
Becomes taxable income essentially.
Yeah,
Yeah.
essentially, yes. And so, but I get that in the same year that I got $300,000 of interest that was paid on a deductible primary residence mortgage. And what, in effect, what just happened there is I converted $300,000 of IRA money into Roth IRA money completely tax-free.
Which is significant because the Roth grows tax-free from that point forward.
Oh, there's so many advantages. That's the biggest one and the most obvious one. But also, Roth IRAs don't have RMDs, so that means I can let it grow tax-free as long as I live instead of having to pull money out of that system like a traditional IRA. Also, if my heirs inherit a Roth IRA, so when you inherit an IRA or a Roth IRA, not from a spouse. So if it's a non-spousal inherited IRA, a spouse inherits an IRA and they can turn it into their own.
Oh, got
But
it.
when you're a non-spouse, so whether it's a friend, a nephew, or it's usually children, but when your children inherit an IRA, they have to distribute the money within 10 years. The Secure 2.0 Act changed
They
that.
have an RMD essentially is what you're saying.
Kind of like that.
Got
It actually used to be an RMD calculation for them, even if they were 2 years old, if it was like a grandchild.
Wow.
Right? It was weird, but that's the way it was. Now it's changed, and you have to take it out in the next 10 years. Well, if I inherit an IRA from my parents, and I'm in my 50s at the time, say, or 60s, I'm probably in my prime earning years, and if I inherit, say, $1 million IRA, I'm just using that for simple math, I have to be very careful how I take that, and I must take it out within 10 years. So a lot of planning goes around that so that I don't take it. If I delay that decision and I'm like, oh, I don't want to deal with it, and I wait till the 10th year and I have to take out, maybe by then it's $1.8 million, I'm going to get a $1.8 million 1099 for distributing that inherited IRA into a brokerage account or whatever I do with the money.
And is that tax like income?
Yes.
Wow.
And
so you're paying 40 or 50% of that to the IRS at that point.
Yes, because if I wait and
you're
take it
earning,
all
right?
out
Yeah.
in the end, so what people will do when they inherit an IRA is they'll try to strategize taking it out of the IRA within that 10 years and do it piecemeal and try to align it with their other tax deductions and things like that so that they can get it out without taking it all out in one lump sum, just jacking their taxes up. But if it's a Roth IRA, then I'm going to let it defer the whole 10 years and take it out on the December 31st of the 10th year, because there's no tax consequence for me taking
Right,
it out.
'cause it's a Roth.
So it's not just for the owner of the Roth IRA. It also eliminates the RMDs. It also eliminates the requirement to take it out. You still have to take it out in 10 years, but you get to leave it invested the whole 10 years.
And the heirs don't pay taxes on that either.
Correct.
Wow.
Like Roth IRAs they're not just better, they're like way better than
Interesting.
IRAs. They're harder
That's
they're
crazy.
harder to fund because you have to
Right.
put after tax money into them.
Right.
But having them is much more valuable.
And there's significant income limitations, right?
For contributions.
Yeah.
You can like Peter Thiel has I think it was $5 billion Roth IRA.
Yeah, he invested.
He invested in some. I think he put $2,000 of a. He almost for his whole life he couldn't put money into a Roth IRA because I had too much income. But my understanding is 1 year he was in college and just didn't have taxable income, and he put $2,000 in of his self-directed Roth IRA, and I think it was PayPal, but don't quote me on that, but in something that most of us didn't have access to at the ground floor, but he did, and it just skyrocketed because he bought it for essentially nothing. Crazy. And now he has a Roth IRA that's worth billions of dollars. And when that happened, Congress even they kicked around the idea of restructuring. Okay, how much money could really be in a Roth before it's kind of ridiculous? And I kind of see their reasoning in that because it's like, this isn't for the Peter Thiels of the world. This is for middle-class Americans to save on taxes. But he did nothing on, well, I don't know if Peter Thiel's ever done anything unethical, but he did nothing illegal with that. He bought it. He had a Roth IRA that was very small, and all of the billions of, the $5 billion minus 2,000 is all growth, and it's all tax-free in a Roth that will all be inherited by his heirs. There will be some estate taxes probably on that, but no income tax because it's a Roth IRA.
So a question I had yesterday, going back to this scenario, you purchase a home with $300K reverse mortgage, 11 years down the road, wouldn't you assume that you ran out of your line of credit at that point?
So if you buy a house with a reverse mortgage, well, first of all, there's a few different kinds of reverse mortgages, and we've been talking about the one that is structured as a line of credit because it's by far the most popular one, but there's different ones that serve different purposes. But if I buy a house, if you think about let's think of it as a HELOC, just because for now that's something most people are familiar with.
Yep.
Let's say I buy an $800,000 house and I put $500,000 down and I use $300,000 of the HELOC or the reverse mortgage. Well, if I wanted to, let's say that's the max amount that I could have borrowed. I've already maxed out the line of credit. And if I wanted available credit left over to me, then I would have had to put $600,000 down and only borrow $200 and leave the other $100 as available credit that I could have used later. I don't know why somebody would do that. Maybe there's some circumstances where we could by design think of why that might serve someone. But for the most part, if I'm buying a house for $800,000, I'm going to borrow money using a reverse mortgage. I'm going to put down as little as possible to keep from liquidating other investments. So if I wanted to bring an extra $100,000 in, just to have access to the $100,000, that doesn't really make sense to me in most cases because if I just left it where it was, I already have access to it. So if I buy a house for $800,000 and I put $500,000 down and I use $300 for the reverse mortgage, then I've already maxed out the line of credit, so there's no available credit left over because I used all of it that I could to buy the house in the first place.
Because theoretically, that $300,000 was your max.
Yes, exactly.
Loan to value.
And so if that grows to say $600 sometime in the future, there's no available credit because I've maxed it out. But when I pay it down, remember the reverse mortgage is an expanding line of credit. So by the time by 11 years from now, let's call it, my credit line itself is $600,000 or so. So if I pay the balance down to $300,000, that opens up the line of credit that I can borrow back out. So a weird part, this is hard for people to imagine because they've never really seen anything like it. But I'm going to compare it to a credit card, although I'm hesitant to do that because we have credit cards for good reason are the kind of debt you should avoid carrying a balance on because of the high interest rate. But if we just think about the functionality of a credit card, it's a credit line, right? I have access to $30,000 on a line of credit, and I can borrow as little or as much as I want up to that limit. And everybody's familiar with how that works. Now, a HECM, the home equity conversion mortgage, which is the technical term for that reverse mortgage that's structured as a line of credit, the variable rate HECM, it's a credit line, just like a credit card or just like HELOC, only what's unique about it that sometimes makes people's heads swim until they digest it is it's a credit line that starts expanding from the day you get it for the rest of the life. For the rest of the life of the loan, I have to remember to say that because sometimes I'll say for the rest of your life, but that's only true if you still live in that house the rest of your life. So it is a mortgage, so it's tied to the house. But it's a compounding line of credit. So if it's $300,000, your line of, I'm not talking about the balance, I'm just talking about the credit limit itself. So if you get a credit card limit of $30,000, how do you increase that credit? Is you call them and ask them to increase it if you want to, and then they decide if they want to. And they could always turn it off if you miss a couple payments, or if for some reason they have reason to believe that that's not a safe bet for them. They can always decrease or freeze your line of credit. Well, with a reverse mortgage, they can't do any of those things. They can't freeze it. They can't turn it off. They can't shrink it. It automatically starts growing from the day you get it. So if it's $300,000 the day I get it, 10 or 11 years later, it's going to be a $600,000 line of credit. 10 or 11 years after that, so 20 to 22 years later. And the reason I can't give you exact figures is because it depends on interest rates. But it's going to be a $1.2 million line of credit. And by the time I'm 92, if I get it at 62, which is exactly what I intend to do, why wouldn't I want a compounding line of credit? What's the downside in having access to that money? So if I never need it, or whether I need it or not, the credit limit isn't respective to how much the balance I've used. Mm-hmm. But the credit limit, if it starts at 300, 30 years later, or 32, 33 years later, is going to be something like $2.4 million. And it's accessible to me income tax free. It's a distribution from a loan, so I don't have to pay taxes. I don't get a 1099 for taking money and putting it in my checking account or buying food with it or helping my kid. Here's another big one that people are starting to tune into, and realtors really like this too because it helps them help families. I have adult children, and I know I've said that earlier, but I try to see the world through their eyes a lot, and I think that's just natural for parents to do. Affordability is a thing that they struggle with. It was a lot easier for me to buy a house in my 20s than it is for my 20-year-old kids to do it now. Rates were lower. Flexibility on mortgages was a little better back then. Homes hadn't appreciated as much. It was just easier for me than I think it is for them. And that doesn't mean, I still encourage people to buy homes because guess what else has been hard? Shelter is, or rent. You have to have shelter. And rent is also more expensive than it was. So I'm sad that it's not as easy for them as it was for me, but there's nothing we can do about that. But home ownership is still better than renting because renting is also more expensive. But when you come across people who are dealing with affordability issues, like people want to own homes, but it's like it's expensive, maybe they can't qualify for the payment, or they don't want to, or for whatever reason, like there's hurdles to that they have to overcome. Well, think about this: if you're a parent or a grandparent, you have benefited, frankly, from the early 1980s to the early 2020s. You've benefited from a falling interest rate environment. That has been a boon for your loans that you've used. It's been a boon for real estate values because more people could afford homes. As that has ended. And what interest rates will do tomorrow or the next 10 years or 20 years, nobody knows. And anybody who tries to tell you that they don't know that they don't know. Right? We don't know that. But right now it's tough for them. For our kids and grandkids, if you're old enough to have grandkids and if they want to buy a house. Well, what you can do is take some of your equity. You can access it through a reverse mortgage, or you could use a traditional mortgage if you want to. But I think if I would qualify for a mortgage where payments are optional, why would I get a mortgage where payments are demanded? I would rather have the flexibility. So I can get equity out of my house through a mortgage, reverse or otherwise, but I would do a reverse if it were me. I can get equity out of my house and help my kid buy a house or grandkid buy a house. Now remember, let's just keep the story simple and say it's my children. If I want to use some of my equity to help my children get started on the journey of their equity and start building some wealth and some comfort and a place, remember, they're raising my grandchildren, right? This is an important thing. If I could give them $100,000 of my equity so that they could start building equity of their own where they're raising my grandchildren, why wouldn't they're going to get the equity someday anyway? And so what people will freak out about, and I get this intuition, I do. What they'll freak out about is they'll say, well, then I owe the interest on the $100,000. And it's like, well, yes. And let's just imagine that you never pay a dime on that. And 10 years later, let's say it doubles. It wouldn't double that quickly, but just to keep the math simple. Let's say 10 years later, you owe $200,000 on that $100,000 loan you took out to give your child $100,000 to buy a house for $500,000. Now, let's look at the whole picture. Again, the biggest mistake is people look at this in a silo. But if you expand the whole picture to what's going to happen intergenerationally anyway, let's look at that child's experience. Let's say it's a son. So your son, your daughter-in-law, and your grandchildren are living in this home. So first of all, they have a home that they can call a home now, where they can go to school in a community where they belong, that sort of thing. There's a lot of value in that that's hard to quantify with dollars. But we can quantify dollars, so let's do that next. If rent is expensive for them, which it is, by the way, it's probably more expensive to make a mortgage payment if you're only putting 5% down or 3% down, or zero if you're a vet. But if you have 100% or $100,000 down, 20%, your actual mortgage payment, including tax insurance and including a little buffer for some maintenance and repairs every now and again, you're already probably paying an equal amount as you would pay in rent. Right? In other words, their cash flow is maybe even slightly improved or maybe roughly equal to what they'd be paying in rent, but now they're buying their own equity and they're benefiting from home ownership. So now let's look at this whole picture. So mom and dad give $100,000 to a son to buy a house for the family. So let's say 10 years later something happens and my wife and I die in a plane crash or some accident where we both die, and let's just imagine something that clean and simple. So my children inherit my house that has a $200,000 mortgage on it that the mortgage wouldn't have been there if I didn't use it to help them buy a house. So in essence, what happened is they inherited $200,000 less because instead of inheriting the $1 million home that's free and clear, they inherited a $1 million home that has $200,000 of a mortgage balance on it because I used it 10 years ago to help them. So if you're looking at the whole picture, what the next question that you'd want to ask is, well, how much equity do they have in their house because I helped them 10 years ago? And with most reasonable assumptions, that number is somewhere in like the $315,000 of equity that they have in their house. Besides the fact that they lived in a home that they owned and raised their kids and went to school and was a part of they were a part of the community, they also have $300,000 of equity plus. That's a conservative estimate. It'd probably be more in the $320,000, $350,000 range because there's debt pay down that happens when you're making a mortgage payment instead of giving it to a landlord. Plus the appreciation belongs to them. So they inherited $200,000 less, but they're $315,000 wealthier because you helped them today.
Right, so they're net $115,000 positive because of that.
Yeah, and of course, that's just the financials picture.
Right,
you
right.
also helped your children live in a house that they own, and there's way more to it than just
the
the
ability
finances.
to purchase. You generally have more options to purchase in a higher quality neighborhood than rent, oftentimes.
Yeah.
You just have more options.
Well, and you got the ability to witness it. How many people get to witness their kids use the inheritance?
I love that you said that. A lot of people in the reverse mortgage space, they'll talk about give your inheritance with a warm hand instead of a cold hand.
Right.
That sounds a little bit, graphic to me, but it makes it kind of poignant because they're going to get the money anyways, and money and time have a relationship that is inseparable. So and we've talked about it like a home ownership situation, and it could be that, of course, but it could also be a college education. Like a college education, maybe it costs, let's say $100,000 again, just a simple number, because it certainly could cost that. That is much more valuable if you have it 10 years longer than having it 10 years later. Could they use that? And would education maybe cost $200,000 10 years from now? Sure. So remember, time and money always have that relationship. So why not give it to them now where you can coach them on how to use it? Because a lot of times that's important to parents. Like, yeah, I want to help them, but I don't know if I'm going to give my 23-year-old kid $100,000.
Right.
Just say, like, here's the cash. Some people will do that. Some people won't. And it might depend on the kid. But if you're alive, that's what you're doing when you pass away. I mean, you can put trusts in place that help, guide how the money is spent. But when you pass away, they get the inheritance, and you're not there to help them and coach them or to see it happen, to see the benefit of your sacrifice for making home ownership a priority, for saving and investing for the future. You can help them now, coach them through it. And again, the initial reaction is, oh, but I'll pay interest on that. Yes, but the amount of time or the timing of when they get that help also has economic value. It may be harder to track, but nobody can deny that it's not real. So if you got a college education 10 years earlier than you would have by inheriting the money that you would have used for a college education, how valuable is a college education for 10 more years of having it? Like you have to think about
those earnings and
Yes, you have to think about the whole picture. You nailed it on the head, Brock. Which is you can't look at it in isolation. You have to look at what did you do with the money.
Yep.
And most people think of it as, well, if I have to use it for medicine and food, then I guess there's no other choice, and that's true. But there's lots of ways that people that understand money will say, well, there's way more things I can do with money than just barely eke by. And for people who need it to barely eke by, that's awesome too. Like, I'm really glad that we can come up with a solution for them. There's lots of ways to use it.
One of our favorite things recently that we just kind of uncovered from a conceptual basis is like, this is so easy for us to say because it's not our money, it's not our kids, it's not, there's no emotion attached to it. And we can just be so pragmatic with the advice. We've recently coined the idea like families, just like the most successful companies, Microsoft, you said earlier, need a board of directors to help them see this stuff because it's not easy it's not easy probably for even you and I. We're analytical freaking people, but it's still not easy for me to see my world as unemotionally as it is for you to see my world. Yeah. And so if I had you in my corner as my board of directors seat to help walk me through all of these ideas, like, hey, well, what if you just gave them the money now? I might be thinking, well, no, these suckers got to work for it, or, I want to see them earn it or whatever. And you might say, that makes sense. But what if we did this, and this, and you get your cake and you get to eat it too. Having professionals in your corner to walk through this, as opposed to turning a nose to it and ignoring the possibilities that these types of things award virtually every family in America, is silly. So I think leverage the pros in this space to be in your board of directors to help you make these pragmatic, unemotional decisions.
I heard a quote just recently, it was like 2 or 3 days ago, that really kind of hit me. I think it was in a show I was watching with my wife, but the character said something like, the only way to approach objectivity is to recognize that it's impossible. That's the first step. Right. So even financial advisors and loan officers and, estate planning attorney, people that are dealing with this stuff all the time, it's like our objectivity. So some people might say, well, nobody's going to be as passionate about my money as me. And that's very, very true. But you also need people who are impassionate about your money to help you see things that you're blind to when you're in the middle of it. And that's true about money, and it's true about relationships with people, and it's true about how you treat your kids and your spouse. And sometimes you need somebody looking at it from a perspective that isn't the subjective perspective that you're experiencing. So it's really helpful to surround yourself with people and to be humble enough to say, hey, here's what I'm doing. What do you think about that?
100%.
And it doesn't mean you have to do everything they say. Just ask for their opinion. That's really helpful, especially if they're experts in a field that is not your field.
Exactly. I think about my brother-in-law. We both leverage him for this. He is a mechanic, like one of the best. He can just fix and build and do anything you can imagine. For me, if I'm going to work on something like my side-by-side, if I'm going to work on something, I'm going to be obsessed about exactly how I screw the bolt in, and I'm going to be obsessed about all this stuff. And for him, he's going to do it in like 1/10 the time, and it's going to look way better, and he's not going to create damage, and he's going to care less. And he's great at that. And guess what?
He can't do it too.
He loves it, right? And it's like relief for him. It's stress for me. And we reciprocate that because when they've got financial questions, he just calls me and he's like, bro, what do I do? And we just handle it. So to your point, it's like you gotta find those people.
Isn't that kind of beautiful? Like life is elegant in that way. People are attracted to the career, and you can tell because they're excited about it. When people are in a career where they're thriving, you can tell because there's just an energy about it. When people are doing what they love, they're usually very good at it. They usually love it, and they usually excel at it. And the world is full of people like that. That's cool.
It's awesome.
Sweet.
Well, what else you got, Teach?
Okay, some quick rapid fire questions that the internet's most common questions, and you might have already answered some of these.
Sure.
But just quick yes or no's or just quick explanation will do. First one, can someone lose their home with a reverse mortgage?
Well, I can't do that one rapid fire because the answer is yes, because you can lose your home without a reverse mortgage. If you don't pay your taxes or if you don't buy insurance and the house burns down, you can lose your home. But that's not a function of the reverse mortgage. That's a function of you didn't pay your taxes. In fact, you will hear some people say, well, my mom had a reverse mortgage and she lost her house. And 99.9% of those stories are because they didn't pay the taxes. And if you don't pay your taxes long enough, the tax authorities have teeth. They can take your house. And then when the kids are cleaning that up, they don't look through the documents and they're like, oh, mom had a reverse mortgage and she lost her house. And I would say, well, hold on a second. If you don't pay the taxes, whether you have a home free and clear or whether you have a traditional mortgage or a reverse mortgage, you're going to lose the house. Yep. Second of all, if your mom couldn't afford to pay the taxes without a reverse mortgage, she would have lost the house 10 years earlier. A reverse mortgage gives people access to their equity without having to make a payment if they can't afford to or if they don't want to. And so if she lost the house and had a reverse mortgage, she probably kept the house 10 or 15 years longer than she would have been able to because she wouldn't have had access to the money.
Right.
So people often get that.
But as a result of the reverse mortgage, you cannot lose your house.
No.
You could be upside down in the house and the bank can't come and
I'm really glad you brought that up because that's one of the biggest features and we've kind of glossed over. I don't think we've even touched it.
We haven't.
But reverse mortgages are what they call non-recourse loans. And most people don't know what that means. And so I'll drill down on that a little bit. What most mortgages are like, and when I say most, I'm talking like almost all of them, they are recourse loans. Nobody says that because it's implied and it would be redundant to say so. So mortgages are recourse loans. And what that means is if the collateral can't pay the loan in full, I have recourse on you as a human being to pay me back. What that means in practical terms is if you owe $500,000 on a piece of property that's worth $450,000 and you want to sell that property, you owe all $500,000 regardless of the value of the collateral. So if the value, I know there's cost to sell real estate, but let's ignore that for a minute. If you sell the real estate and the net proceeds are $450,000 and I have the loan and you owe $500,000, well you owe $50,000 because I only recouped $450,000 from the sale. You owe the $50,000 and I can go after you for that from a legal perspective. And by the way, that sounds harsh and cruel, but society must be that way because if it didn't work that way, your money at the bank wouldn't be safe if they could lend it to people and not get it back, right? So it has to work that way for society to function. But those are recourse loans. A non-recourse loan by definition means that the collateral is guaranteed to satisfy the loan regardless of the value. So what that means is if you owe $500,000 on a non-recourse loan, reverse or otherwise, so reverse isn't the only kind of non-recourse loan, but others are very rare. But if you owe $500,000 on a reverse mortgage and the house is only worth $450,000 and you want to move and you want to sell the property, or you pass away and your kids are selling the property, now there's no equity left over because you've taken it all out. It's sitting in the bank. It's supplied you food and medicine and lifestyle for the last 20 years or whatever. So there's no equity left because you owe more than the value of the house. But that difference of $50,000 isn't owed. It's non-recourse.
By anybody.
The bank has to, you could say the bank has to eat that, but the way they solve that is with mortgage insurance. But either way, it's not the borrower's problem. It's not the heir's problem. It's not the estate's problem. It simply is not owed. So you can never owe more than the value of the property when you sell or pass away. That's what a non-recourse loan means.
Well, and I think this is something important because there are a lot of emotions around this, and most people have integrity. So most people are thinking, man, that seems unethical that I'm just going to not pay the bank what I've accumulated. I don't feel good about that. So hit on that point why you should feel good about it, which is the insurance policy that you just mentioned, mortgage insurance.
So one thing, and maybe this is one of the questions that you were going to come up with, but one thing that people think is that reverse mortgages are expensive. I have a lot to say about that, so I'll just keep it to a couple of sound bites. But that's kind of an impractical thing to say, which is one of the reasons why we called the book The Financial Ugly Duckling. And just to touch on that really quickly, the reason the duck family thinks that baby swan is an ugly duck is because the reason that comparison is tempting is because swans do have some things in common with a duck, right? If it was a baby kitten, nobody would make that mistake. Right, that doesn't look like an ugly duckling. It's a different animal, clearly. But because swans and ducks have some things in common, it's easy to compare the two. And people do that with traditional mortgages and reverse mortgages all the time. And one of the comparisons that they often make is, well, that mortgage is more expensive than a traditional mortgage. And I think to myself, okay, hold on a second. A Kenworth diesel semi-truck, brand new, costs about $200,000. But if you were running a trucking company, you wouldn't consider replacing your fleet with F-150s because they're cheaper, right? That doesn't make sense. They're built completely differently for a different type of thing. But that's easy to see when you're talking about a truck, something that you can see. And it's different when you're talking about financial products because they're contracts and they're paperwork. But if you look at the reverse mortgage, so we've talked about a line of credit that's ever expanding. It's not due until you die or move from the house, and it's non-recourse. So if you ever owe more than the value of the home, you don't owe that difference. Well, of course that's priced differently than a traditional mortgage. You don't have to make payments, and if it exceeds the value of your home, you don't owe that. How is the bank going to offer those kinds of terms without pricing that in? They have to price that in. And so sometimes when you describe the features of a reverse mortgage, I think one of people's instincts is to think, well, that sounds too good to be true. I can borrow money and I don't have to make a payment if I don't want to. And then when you talk about how they price that in, they usually price it in with a mortgage insurance policy. Most reverse mortgages deal with that with a mortgage insurance policy. And the ones that don't, by the way, price it into the rate, so they'll have higher rates. But either way, they have to price in that risk, of course. So people will say, all those features sound too good to be true, and then they'll look at the cost and they'll be, well, that looks like an expensive mortgage. And I'm like, you can't have it both ways. Something can't be too good to be true and too expensive. Those are conflicting ideas.
Right.
That's just how it has to get priced in, because every financial tool on the planet has to make sense on the financial side of the equation. Otherwise, financial institutions couldn't offer it. It has to be sustainable to them. So they price that in with a mortgage insurance policy that for the FHA loans costs 2% of the value of the home. Now that is capped at a home value at $1.25 million. If the home is worth more than that, then the insurance doesn't go up. But so that is capped. But people will look at that and they'll say, and this mortgage costs other expenses as well, because mortgages are a process, and it takes, there's underwriting and processing and appraisals and things that have to happen to make a loan happen. And so these loans cost those expenses as well. And in addition to that, there's that mortgage insurance premium. And so if people look at that and compare it to a traditional mortgage, they're comparing a duck to a swan. This is a financial tool that does something entirely differently. And so comparing the cost of each is an incorrect comparison. The way I like to compare it, and we mentioned this in the meeting yesterday, is if you think your house has had 4% appreciation, I think that's pretty conservative over the last 10 years, but maybe not 20 or whatever. But if 4% is a pretty reasonable number, but if you expect your house to appreciate by 4% in any given year on average, half of that appreciation in 1 year is what it costs to add this line of credit that's ever expanding using your house as collateral. Let half of your house's appreciation in 1 year pay for that feature so that now your equity is liquid to you. That's a better comparison than, well, that costs more than a traditional mortgage. And if that price doesn't make sense to you, then pay less and be required to make payments and all the other, and have a recourse loan with a traditional mortgage. But to have the features of a reverse mortgage, it has to cost differently because it is different.
And the point is, you paid for this mortgage insurance policy. And so the ethical debate here is like...
I got lost.
It's
We
okay.
didn't get back to that, did we?
It's okay. But the ethical debate is like, well, you paid for a mortgage insurance policy that cost you money. Why would you not cash in on that? And you brought it up yesterday. Like, if there was a storm and the roof of your house was trashed, you would have no hesitation to call your homeowner's insurance policy or insurance company to get the roof replaced. This is the same concept. If you're underwater on the house, which frankly is unlikely. Like I told you, my personal experience, she didn't lose a dime of equity. She never made a payment and actually bought a car and funded a bunch of stuff. She had a battle with cancer, funded a bunch of medical bills and things late in her life with this reverse mortgage. And when she passed away, the family got as much equity as they would have gotten if they would have just got the equity as soon as she sold the previous house and bought this one. Like, in reality, it's unlikely you'll go upside down. But in that unlikely event, you shouldn't have an integrity battle here because you paid for an insurance policy to cover that risk.
Yeah, that's
for the
absolutely
bank.
right.
Yeah.
In fact, it would be unethical, I think, for them to deny you.
Right.
That would be weird for them to charge. If you've been paying premiums and you get into a situation where you need to make a claim, you make the claim, and that's what it's for.
That's what the insurance is there for.
Yeah.
Love it. Anything else?
No, he covered all of my rapid fire questions and that.
And then some, probably,
yeah.
right?
No, it's all good. That's what we're
Well,
here
dude,
for.
thank you so much.
You're welcome.
You are like a brilliant mind. Hopefully
you.
people go crazy on this and we have you back for maybe something more pointed if you're willing, but I think this was awesome and we appreciate all the time you took doing this.
I would love it. I love what I do, and I think at the end of the day, I'm one of those people, and I'm not describing how I feel or making a moral claim of any kind. I've just recognized that money itself doesn't motivate me. I want money. I need money. I recognize that it's valuable. But if I get up and go to work just because I need to make money and want to make money, then I'm slogging through the day. That isn't what drives me. Now I know I need it, and I do. Money is a good thing, but I do get a ton of satisfaction out of, like, there are people in cases. We've talked about tax strategies. We've talked about ways that wealthy people can use this to minimize taxes, minimize opportunity costs, and use them in clever ways. But also, like your grandmother, that story, there are people who shed tears when they realize, like, I was so embarrassed that I didn't want to tell my kids that I was out of money, or I was skipping meals, or people are breaking prescription pills in half because they can't afford all of it. So there's everything, and everything in between, by the way. So there's people that direly need access to their equity, and there's people that use it in strategic ways. And I can't tell you how fulfilling it is. And what's sad to me is that there are people everywhere who have money that they didn't know they could access in the form of home equity, and they're struggling. And they're being told by people that they shouldn't spend their equity, and that's ridiculous. Like, think about that person's children, and how would they feel if they knew? In fact, Dr. Pfau, in that book that he wrote about it, he hints at this idea, and I think he touches it lightly, and maybe for political reasons, but he makes a point, like, we might have fiduciary liability in the future if we don't grapple with how to think about home equity in the financial planning process. His audience is financial planners, and I think that's very true. So imagine this: let's say you're cleaning up your parents' estate. They've passed away, and they've hidden some things from you because maybe they were embarrassed. And you're cleaning up things, and you realize they've spent all their cash. They've been skipping meals. You look in their pantry, and there's nothing there but peanut butter and hot dogs or whatever, and they've been struggling, and they didn't want to tell you. That happens more than you want to admit. It happens. And then you inherit a $900,000 paid off house. Wouldn't you be kind of furious about that?
Oh, it breaks my heart even imagining that idea.
And so, and if I were that kid, or that, I mean, not a child, but like that heir, I would go to the financial advisor that was advising my mother until her money ran out, and then it's like, well, you don't have any money, you're not a client anymore. And I'd be like, dude, or ma'am,
what the hell's your problem?
Yeah, like, you, a thought leader in your space, Dr. Pfau, he wrote a book about these in 2015 saying that you need to learn how to incorporate home equity into the financial planning process. I can see that there are CE classes for you to learn about this thing. How can you, now I'm not saying that a reverse mortgage is right for everybody, but how can you have ignored that in my mom's case where that could have helped her live in dignity, or whatever that means, or maybe even live 5 years longer because she had the resources that she needs. It doesn't need to be an inheritance. So again, that's one end of the spectrum. There's other ends, or there's another end of that. But I think if more people were less afraid of how to use this, and there were more professional approaches saying, you don't need to be afraid of this. Imagine, like, there's money involved here. So that's kind of a fun science. I'm sort of drawn to that. I think we all kind of geek out about that stuff. But when you translate how that plays out into Nana's last 20 years of her life, it's hard to put a price on that. That's a real thing. And so I get very motivated about, there's people that we can help just by helping the professionals know when to recognize, hey, somebody could use this. I know how this might help somebody who's having a cash flow problem, or who's worried or embarrassed to talk to her kids or his kids about it. We come across that all the time in this industry, and it's heartbreaking and rewarding at the same time. What's really heartbreaking is when somebody says, hey, can you help this person? It's like, we can't. They don't own the home, or they don't have any equity or whatever, like, because we can't do 100% loan to value reverse mortgage. So sometimes it's heartbreaking and there's nothing to do about it, and it's sad because these aren't numbers on a spreadsheet. I mean, they're also that, because that's how business works, but they're humans living lives out there. But there are so many people that are struggling needlessly, and if they just recognize that their home equity is as accessible to them as an IRA would be, like we said earlier, if that money were sitting in an IRA, nobody would think twice about selling it and using it to fund a lifestyle. Yeah. But because it's in home equity, we think of that as somehow weird. But financiers have figured out a way to solve that problem. Just use that. Yeah. And what's funny to me about that is when we think of the money in equities, in stocks, it's funny to me how we think of those in two different categories, because we literally use the same word for it. Equity, right? If you had equities in stocks, you wouldn't think twice about using it. But if it's equity in a piece of real estate, you get weirded out about it. But it's this, we use the same word for a good reason. It's equity.
Yeah, that's awesome.
For sure. Well, Brady, thanks again for sharing this. This is life-changing information, and this is what holistic mortgage planning is all about for us. And if you're at home listening to this or watching this, please do us a favor. If you've got friends or loved ones that need to hear this, please share this with them, and we'll catch you on the next one.
Thanks, TJ. Thanks, Brock.
Thanks for listening to the Loans Elevated podcast. For more resources, tools, and market updates, visit loanselevated.com. Don't forget to follow and subscribe for next week's episode.